Hello everyone, welcome to the 142nd episode of me learning how to trade in Forex. So in the last episode we went through developing an unbiased and positive approach. Basically everyone has biases, they play a massive part in everyone's life or everyone's everyday life, so there's no way to get rid of this bias altogether, but if you're aware of how it manifests itself, then you stand a much better chance of minimizing the impact on your trading. So we went through some of them bias examples. So for example, we've got representative bias, negativity bias, gambler's fallacy, status quo bias, confirmation bias, loss aversion bias, and herd bias. And then we looked at the successful traders' emotional traits, so decisiveness, self-aware, and disciplined. And then we went through the lesson summary. So now we're on to common trading mistakes part 1. So, common trading mistakes, part 1. Date is the 21st. Right, okay, so common trading mistakes part 1. No trader gets it right every time. We'll make occasional mistakes, and that's nothing to be ashamed of. In fact, it's often a good way to learn. However, you can reduce your risk of blunders by being aware of the pitfalls that frequently catch out other traders. In this section, we'll run through some of these common errors so you can learn from the mistakes of others and steer clear of them yourself.
No trader gets it right every time, but you can improve your chances by knowing which pitfalls to avoid. Here are 5 of the most common trading mistakes. Number 1, not preparing properly. Many beginners rush in with misguided confidence and are punished for it by the markets. Don't be one of them. Take the time to learn about financial markets and trading strategies and consider practicing with a demo account before using real funds. Number 2, trading without a plan. Failing to stick to a trading plan or trading without one is a recipe for disaster. To avoid this problem, develop a personal trading plan and use this to decide when to enter and exit trades. It's a good idea to keep a trading log, a record of your trades and the reasoning behind them, as this can help you adjust your plan over time. Number 3, over-reliance on software. While technical analysis, advanced charting systems, and automated algorithms can all enhance your trading, blindly following a software program is unwise. Remember, these are just tools, not foolproof strategies. Make sure you understand how each system works so you can make informed decisions about whether or not to trade. Number 4, failing to cut losses. All traders, no matter how skilled, will inevitably enter some losing trades. And while you may convince yourself a market can't keep going against you, one of the most dangerous misconceptions is thinking you can always turn running losses into profit. So it's critical to decide when you will close losing trades and to remain disciplined in the heat of the moment. Use stop losses to ensure you exit according to plan. Number 5, overexposure. Beginner traders often fall into the trap of overtrading. For example, opening a host of positions in the wake of an early success or spreading capital too thinly in an attempt to trade a wide variety of assets. But with thousands of markets on offer, you can't take advantage of every opportunity. So sit back, consider your trading strategy and only open a new position if it fits with your plan. To learn more about trading, including common mistakes, join IG Academy today. It's completely free and gives you access to short, step-by-step courses and webinars on a wide range of trading topics.
Nice. So, insufficient preparation. As Benjamin Franklin said, by failing to prepare, you are preparing to fail. And in the world of trading, such failure can cause significant financial pain. So it really does pay to do your homework before you venture into the markets. Use the host of resources of insufficient preparation was it common trading mistakes. So common trading mistakes. Insufficient preparation. So okay, do your homework before you venture into the markets. Use the host of resources available. Books, courses, trading conferences, the internet to keep yourself informed about the latest trading ideas and techniques. Use the host. Use a variety of resources, of available resources. These include books, courses, trading conferences, the internet to keep yourself informed of the latest trading ideas and techniques. Take your time to understand the markets that interest you, how they work and how they've been behaving. Take your time to understand the markets that interest you. With how they work and how they've been behaving. Create a trading plan to suit your trading goals. Create your trading plan to suit your trading goals, your skills and knowledge, and your feelings about risk. Your trading goals, your feelings about risks, and your skills and knowledge. Practice trading using a demo account, where you can get comfortable with using your trading platform and try out strategies in a safe environment. Practice trading in a demo account, where you can get comfortable using the platform and try out strategies in a safe environment. You may know of some experienced successful traders who make it look easy, but unfortunately trading is not just a case of opening position and waiting for the profits to roll in. A degree of skill and knowledge is essential. Too many new traders rush in with misguided confidence and are punished for it by the markets. Don't be one of them. Not following a plan. Suppose you need to travel from Edinburgh to New York. Would you just step out the door and set off without researching a route or checking tickets availability? Without doing a little advanced planning, you would be unlikely to arrive at your destination. In the same way, heading into a trade without having a plan can get you into trouble. In the Planning and Risk Management course, we talked in detail about how to create a trading plan. Once you've done that, it's important to stick to the course you've plotted for yourself. You may be tempted every day to ignore your trading plan, just stay in a little longer on this trade, or go in heavy on that one. But if you've really taken the time to develop your trading plan, then you should have faith in it being the best suited approach for you. Even the best trading plan remains only a guide, but the better the guides and the better you can follow it, the better your chances of success in the long run. Make sure you follow the trading plan you've created for yourself. Make sure you strictly, let's add strictly in here. Make sure you strictly follow the trading plan you've created for yourself. So this is a summary. Make sure you have all the skills, knowledge and tools you need before you enter the markets. Create a trading plan, stick to it, have faith in the strategy you've picked. Make sure you strictly follow the trading plan you've created for yourself. Yeah, that sounds right. Common trading mistakes part 2. Common trading mistakes part 2. 21st. Over reliance on software. Over reliance. Most people use some sort of technology to assist their trading. For example, you might study chart patterns or use automated alerts and algorithms as prompts to trades. But as useful as all these tools are, it is important to remember that they're only tools and must be employed wisely. Just as your sat-nav can occasionally direct you to drive into a deep torrent of water because it doesn't know the river has flooded, trading technology isn't something to follow blindly. You still need to keep your eyes open and react intelligently to the signs you see. So when using technology such as charting software or other analysis tools, it's important that you understand the underlying concepts and the reasons behind what the charts are telling you. This will allow you to see the bigger picture and avoid unnecessary mistakes. So, remember that trading technology isn't something to be followed blindly. You still need to think about the signs you see. Ensure you understand the underlying concepts and the reasons behind what the charts are telling you, which will allow you to see the bigger picture and avoid unnecessary risks and avoid unnecessary mistakes. Lack of record keeping. Do you remember your first trade? What about the third or the fifth? If you're new to trading, the details may still be clear in memory, but in a few months' time, will you still be able to describe each step and decision in detail? Unless you keep a trading log or diary, the chances are that this information will be lost. And if you can't remember what you did right, how can you replicate it? Similarly, if you don't know where you went wrong, you could easily make the same mistakes again. Your trading diary should let you look back at your experiences with the value of hindsight and learn from them. So what should you record in it? Keep a trading diary so you remember every trade you've you've ever done in detail. Your trading diary will let you look back at your experiences with the value of hindsight and learn from them. So what should you record in it? Which of the following is not worth putting in your trading diary? Why you decide to trade, that's worth. What you were wearing at the time, that's not worth. Where you place your stop limits, how you felt at the time you opened and closed your trade. Yeah. Your trading diary should contain details of each trade, the reason for making it, and all the factors that affect it, including your emotional state. As you build up a trading history over time, you'll start to identify patterns and work out which strategies are the most successful for you. A detailed record of your past trading decisions and their outcomes will also help you avoid making the same mistakes in the future. It's an immensely powerful tool, but neglecting it is unfortunately one of the most common and costly trading mistakes. Diary should contain details of each trade, the reason for making it, and all the factors that affected it. This includes your emotional state. And all the factors that affected it. So what affected you making the trade? Was it, so you could write something like, oh, someone told me that this trade was going to make a huge profit, so I went along with what they said. So that could be a reason to put down in your trading diary. As you build up trading history over time, you start to identify patterns and work out which strategy is the most successful for you. As the trading diary gets built up over time, you'll start to identify patterns and work out which strategy are most successful for you. It will also help you avoid making the same mistakes in the future. It's an immensely powerful tool, but neglecting it is unfortunately one of the most common and costly trading mistakes. Cool. Bad timing. Timing is not only the art of good comedy, it's also essential to good trading. In the same way that a stand-up artist needs to deliver the punchlines at exactly the right moment, you need to time your entry and exit from a market perfectly to maximize any profit or minimize any loss. Perfectly, not perfectively. What was that word? Perfectly. Timing, so you need to time your entry and exit from a market perfectly to maximize any profit or minimize any loss. Timing mistakes are common among new traders, so how can you avoid them? Although getting your timing right isn't an exact science, there are a few tools that can help you act at the right moment. Chart analysis will help you forecast potential scenarios by revealing market patterns. Trading plan will help you define your strategy, meaning you're more likely to avoid impulsive actions. Stops and limits will allow you to go about your business without having to monitor the markets constantly. Although getting your timing right isn't exact science, ways to mitigate timing mistakes. Chart analysis. So, helps you to forecast potential upcoming potential scenarios by revealing market patterns. Trading plan helps you define your strategy. So you're less likely to so you're more likely to avoid impulsive actions. Stops and limits will allow you to go about your business without having to monitor the markets constantly. Helps you to automatically stop trades without needing your full attention all the time. Helps you to automatically stop trades without needing your full attention all the time. Full attention on the market all the time. Yeah, that sounds right. So, lesson summary. Remember the limitations of software and use it intelligently. Keep a trading diary and reflect on the strategies that worked well or not so well. Use tools such as charts, stops and limits to help you get your timing right with opening and closing positions. Common trading mistakes part 3. Common trading mistakes part 3. Not cutting your losses. It's inevitable. Sometimes things don't go to plan. You end up running a loss on a position. So not cutting your losses. Not cutting your losses. It's inevitable. Sometimes things don't go to plan. You end up with a running loss on a position. There will be times where you can ride out the storm and eventually turn a profit, but on some occasions it's best to quit before the situation worsens. A running loss will be inevitable in the future. It's best to quit before the situation worsens. It's best to quit the trade before the situation worsens. So how can you tell whether you should hang on to your losing trade or So how can you tell whether you should hang on to your losing position or not? Question. So I've got the FTSE 100 here. Richard and Jack have both opened long positions on the FTSE at the same time. Unfortunately, so they've both gone long, so they want the market to go up. Unfortunately, they picked the wrong moments to buy. The index is now sliding, and both are seeing increasing losses. So I'm assuming they bought from here, and they're shopping. Richard likes to trade on instincts, and he has a feeling that the FTSE will soon rise again. He doesn't set any stop losses, preferring to monitor the market and make decisions on the fly. The loss figure on his FTSE trade is now making him hot under the collar, but he tells himself everything will be fine if he just holds his nerve. Jack, on the other hand, takes a disciplined approach on trading. He has created a trading plan to outline strategy, and he follows its guidance when deciding whether to close a position. He also keeps a trading diary and refers back to his previous trading decisions. He has set a stop loss to automatically close his FTSE trade if losses reach an intolerable level. Which of the two traders is more likely to make a wise decision about whether to exit a FTSE trade? Jack. Correct. Although instinct can have its place in trading, experts generally agree that a more ordered strategic approach is the key to consistent success, particularly for the less experienced. The right decision on any given trade may vary from person to person, but by using tools to help you stay objective, you're more likely to make choices that leave you feeling satisfied with the end results. Using to help you stay objective. Stay objective. And don't rely on instinct. Using tools and tools to help you, you're more likely to make choices that leave you feeling satisfied with the end results. Overexposure or underexposure? With an almost infinite range of financial markets and trading products to choose from, one problem a trader is unlikely to have is boredom. However, sometimes it can be tricky to strike the right balance between at one extreme, trying your hand at everything, and on the other hand, sticking only to what you know well. While it is risky to go too far outside your comfort zone or spread your capital too thinly, you shouldn't restrict your options excessively either. Just keep in mind, the wider the range of asset types you trade across, the more time and energy you will need to monitor the factors affecting each one. So, keep in mind that the wider the range of asset types you decide to trade across, the more time and energy you'll need to monitor the factors affecting each one. Question: which words should be inserted to complete the sentence? A something portfolio is a sensible way to spread something, but don't be tempted to enter markets if you haven't something or don't fully understand. A diverse portfolio is a sensible way to spread risk, but don't be tempted to enter markets if you haven't researched or don't fully understand. There we go. A diverse portfolio is a sensible way to spread risk, but don't be tempted to enter markets you haven't researched or don't fully understand. Misunderstanding trends. Imagine the Dow Jones have been steadily moving upwards over a long term. When a worse than expected non-farm payroll reports cause it to tumble, does that mean it's now in a downtrend? Inexperienced traders might assume the answer is yes, but in fact that's unlikely to be the case. A trend is a long-term direction a market is taking. A trend is a long-term direction a market is taking. Generally, this is determined by macroeconomic influences rather than individual political or economic events. So generally, this is affected by not affected. This is determined by macroeconomic influences rather than individual political or economic events. So in our example, you might see the Dow Jones resume its uptrend after the initial volatility subsides. There's an abundance of software available to analyze market trends, and these tools can be valuable if used correctly. You should just be careful to distinguish between short-term and long-term influences, as these may not be aligned. So ensure you distinguish between short-term and long-term influences, as these may not be aligned. Now we've got a video here, so
no trader gets it right every time, but you can improve your chances by knowing what pitfalls to avoid. Here are 5 mistakes to steer well clear of. Technical analysis, advanced charting systems, automated algorithms all can enhance your trading, but blindly following a software program can often be a recipe for disaster. Remember, these are just tools, not foolproof strategies. It's important to understand the underlying concepts behind the trends and patterns before placing any trades. Timing is not an exact science, but inexperienced traders will often act at the wrong moment. You can improve your timing by keeping a detailed trading log to track your previous mistakes, using charts to help forecast scenarios, and sticking to a clear trading plan to stop you acting on impulse. You may convince yourself a market can't fall any further, yet one of the most dangerous misconceptions is thinking you can always turn running losses into profit. Knowing when to cut your losses is a key skill to develop. Look back at your trading log, refer to your trading plan, and work out how much you're prepared to lose before you trade. Then place stop losses to make sure you exit when planned. When it comes to trading, there's no such thing as a winning streak. With the euphoria that comes with a big win, there's a temptation to believe you're on a roll. But you should never let the excitement cloud your judgment. Sit back, consider your trading strategy, and only open a new position if it fits with your plan. The experienced trader should always be aware of what's at stake. To find the risk-reward ratio of any trade, compare the amount of money you could lose to the potential reward. So, if you're risking £200 but you stand to win £400, then the risk-reward ratio is 1 to 2. What ratio you decide to go with depends on your risk appetite, but generally novice traders should stick to low-risk, high-reward trades. So remember, always keep these 5 mistakes in mind before placing your next trade, and focus on trading with your head, not your heart.
okay, so the lesson summary. Be disciplined about closing your trades to cut your losses when markets move against you. Maintain a balanced exposure to a range of assets while taking care not to diversify too far. Remember the differences between long-term market trends and short-term reactions or sideways trends. Maintain a balanced exposure to a range of assets while taking maintain a balanced exposure to a range of assets. Whilst taking care not to diversify too far. Yep. So, quiz. If you're anxious about the transition from a demo account to live trading with real funds, what shouldn't you do? What shouldn't you do? You shouldn't place a big high risk trade. What will a trading plan help you do? Remove emotion from trading, do your thinking up front, doesn't forecast market movements, achieves your trading goals, does not keep your desk tidy. Which emotion might cause you to make a hair trigger trade? Anger, right? What might do if you go on tilt? Make irrational decisions. If you have a series of profitable trades, the chances that your next trade will also be profitable increases. False. What might lead you to see only the news information that supports your view of the markets? That's a confirmation bias, isn't it? Which of these personal characteristics are not likely to help you become a successful trader? Not indecision, impulsiveness. Yeah. What should you put in your trading diary? Why you decide to trade, your stop limit levels, your emotional states, your profit loss. Which of these following is not likely to help you time your trades correctly? Which of the following is not likely to help you time your trades correctly? Is not. Why do I keep clicking my right mouse? It's not likely to help you time your trades. Acting purely on instinct. Yeah. A trend is a market's long-term direction. 90, right, okay, so. Yep, by sticking to small size trades on markets you understand and applying the tools and strategies that work for you in your demo account, you should be able to stay within your comfort zone. What will your trading plan help you do? Your trading plan gives you structure to follow in the complex world of the financial markets. By deciding what you want to achieve and planning how you get there before you start, you can avoid being sidetracked by emotions in the heat of the moment. Which of the following might cause you to make a hair trigger trade? When things have gone wrong, it's natural to feel anger. Angry traders sometimes respond by placing another trade without properly considering it, as a knee-jerk reaction. This is known as a hair trigger trade. So emotions such as frustration and regret can place traders in a state of mind where they make irrational decisions rather than acting on common sense and hard evidence. This is called going on tilt. The belief that I am a winning streak is common and dangerous delusion. Just because a certain market or set of circumstances has been lucky in the past, it's not especially likely to be so again. Always assess the merits of each trade in its own right. The key to consistent profitability is your skill and care, not luck. If you're convinced that a particular market is set to rise, for example, you may find yourself dismissing any news or commentaries you read that indicate otherwise. Instead, you would focus only on the information that supports your view. This is confirmation bias. Oh, sentimentality. Successful traders tend to be calm and rational. They act quickly and decisively when necessary, but are not impulsive or impatient. They know their own strengths and weaknesses and have strategies to minimize the impact of their emotion on their trading. Sentimentality. Does that mean you're getting like too emotional and stuff like that? Oh, right, I don't know. I wasn't really sure what they meant by sentimentality. But yeah, emotions, no. What should you put in trading diary? Your trading diary will help you review all the factors that contributed to your successes, or that had an impact when things didn't go so well. You should record everything that could potentially be relevant, including your emotional states at the time. This will help you replicate the things you did right and avoid repeating your mistakes. Of course, if you think what you had for lunch could be relevant, by all means record it. Fairs. Basing your trading decisions on facts rather than feelings is the most likely formula for success. Analyze the information available and plan your trades carefully. Tools such as stops, limits, alerts, and algorithms can help you automate your trading, so you don't have to watch the market constantly yourself. Analyzing will help you plan tools such as stop limits, alerts, and algorithms can help you automate your trading. Yep. A trend is a market's long-term direction. Traders commonly misunderstand and misinterpret trends. A sudden change in the market direction triggered by a news event is often temporary and doesn't mean and probably doesn't mean the long-term trend has reversed. But the news events, what if it's like a really big news event? Like, it'd be interesting to find out what sort of like news events actually does make a change of trend in a market. Because because then if it shows up again next time, you know that, oh, because it's changed the market in the past, it might change the market again this time. So yeah. Cool. So what course was that? I think that was trading psychology, wasn't it? Common trading mistakes, part 1, part 2, part 3. Yep. So trading psychology's done. Now we're on to how spread betting and CFD trading work. So spread betting and CFDs are two alternatives to traditional trading that you often hear mentioned in the same breath. So what do they involve? What are the differences? And how do you decide whether they're right for you? In this course, we'll run through all the essentials of these derivative products, explaining how they work and why people use them to take a position on the financial markets. You'll learn how both spread betting and CFDs offer a number of similar benefits and generally involve the same risks, but also that they differ in certain key ways. And by the end of the course, you should feel equipped to get started as either a spread bettor or a CFD trader. Nice. But I am going to leave this episode here. In the next video, we're going to start with what is spread betting in the how spread betting and CFD trading work. So thank you for watching. Bye bye.